This is the story of how a $45 billion fund collapsed in a matter of days. Situational Awareness, a fund started by Leopold Aschenbrenner. It used to be, just a month ago, a $45 billion fund, and now it was forced to liquidate and close its doors. In this video, I'm going to cover how did that happen and how you can avoid that. And it happened basically because of three main things: excessive leverage, having a non-diversified portfolio too much concentrated in just a few stocks, and the lack of hedge. Alright guys, let's get into it. This is an extremely interesting story. Leopold Aschenbrenner is a very young guy. He is now 25 years old. He used to work a few years ago, 2 or 3 years ago, to OpenAI. He was fired because he didn't agree with the company, and he started his own hedge fund called Situational Awareness. Situational Awareness was named after an essay that he wrote. Actually, very brilliant essay. I would really suggest you to read that essay, Situational Awareness, which tells you where AI is going and when AGI, artificial superintelligence, will come up. And Leopold is a very smart guy, and he was investing perhaps in the right companies, but with the wrong risk management, definitely with the wrong leverage, and also with the wrong concentration and wrong hedge. So this is what happened. In the last week of July, some of the stocks in Aschenbrenner's portfolio, Situational Awareness, were down 30, 40, up to 50%. And basically because there was too much leverage in investing in these stocks, he was investing with a 4x leverage, he was forced to liquidate and sell the portfolio at a huge discount to Citadel. Citadel is a huge asset management out there, and they bought all the stocks in the portfolio, at a bargain. And now basically he will have to move on to something else. And I think this was a big lesson, because you might be very, very smart. Leopold Aschenbrenner, definitely a very smart guy, but if you don't have experience in risk management, whether you are a large fund manager or you are an individual investor, you can go belly up. So this video is going to show you how not to go belly up. And why should you listen to me? My name is Henry. I'm also a hedge fund manager. Definitely my fund is way, way smaller than Leopold's fund, $45 billion. But I've been a student of leverage for many years. I love using a certain level of leverage. In today's video, I'm going to tell you exactly what kind of leverage you should use. And here is the number one mistake of Situational Awareness: too much concentration into 4 different stocks. The 4 stocks that I'm about to tell you, they might be good investments, but the fund was 80% invested in these 4 stocks: Nebius, Bloom Energy, SanDisk, and CoreWeave. Now, these are good stocks and good businesses. Actually, I have some of these stocks in my personal portfolio, and in my Henrique Wealth Academy, you can check the link in the description. I have recommended some of these stocks in the past, and our members are very, very happy with the performance of these stocks. The problem is that when you invest 80% or the vast majority of your portfolio into 4 different stocks, which are highly correlated because they are all related to the AI build-up, well, now if the market crashes or if these stocks have a large downturn, you will basically be in a very, very bad place. And this is a lesson on how even very smart investors with very good investment theses might go belly up, because very high concentration in one single sector, even if you are right, if these stocks crash because of market cycles or because there is a market correction in the AI space, then you are in a very bad position, right? So stay diversified, and the best way to get diversified is investing in index ETFs. S&P 500, Nasdaq 100, probably Nasdaq 100 will give you access to most of these stocks that are part of the AI build-up, but you are automatically exposed to 100 different stocks, not to 4 stocks. Okay, if you want to build an individual stock portfolio, you can also do that. I have a 5-hour-long course about individual stock portfolio, how to pick stocks and all that stuff. But what I tell people is you should pick 10 to 20 different stocks. 10 to 20 different stocks will give you some concentration and also enough diversification. And you should also invest in different sectors. It shouldn't be all into one single sector. Okay, the second big reason why Situational Awareness went belly up was too much leverage. Look, you might be right in your bet, but if your bet is volatile, it doesn't matter, okay? Unless you have perfect timing which no one in the world has, okay? So what Leopold did was investing in these 4 stocks, the majority of portfolio, Nebius, Bloom Energy, SanDisk, and CoreWeave, with 4x leverage. 4x leverage means that basically a little bit of volatility, over 25% volatility, will wipe you out. And that's what happened to the fund, right? There was some volatility very recently. Some of these stocks dropped 30, 40, even 50%, which is the case of SanDisk. And that's enough just to wipe you out. And that's it. That's why I'm very against using single stock leverage ETFs unless these stocks are very low volatility. Let's jump here on the screen and you'll see what am I talking about. So as I told you, I'm a student of leverage and I have created for TradingView my Kelly curve indicator. If you plug here an index such as the S&P 500 and Nasdaq, you'll see that you can use 2 to 3x leverage safely. But for example, when I plug here Nebius, what my indicator tells me is that 1.12x is the maximum leverage that you should use. So basically 1x, you can use maybe increase your position by 10% with leverage. But the problem is that Leopold was using 4x leverage. And 4x leverage is a no-no, as you can see here, right? 4x leverage will totally wipe you out. What about Bloom Energy? Bloom Energy, same story. The indicator is telling me that maximum leverage will be 1.34x. So you could increase a little bit beyond the 1x, just normal exposure, no leverage, but he was using 4x, and 4x, it's a no-no again here for Bloom Energy. Despite it's a good company, you know, it's a good stock. SanDisk, I also think this is a good stock, but it went down by 50% in just a few days. And what happens when you are 4x leverage and stock goes 50% down? Well, I guess you know by now what happens. And again, the Kelly optimal leverage will be 1.3. Same for CoreWeave. CoreWeave is actually, my indicator is telling me that you should go short. You should not even long this stock. Historically, you have done much better if you do a short. But guys, basically what I'm saying is that you should look at this Kelly criterion indicator. Kelly criterion, if you are new to my channel, was created by John Kelly Jr. in his paper from 1950, I think it was from 59. He was working at Bell Labs, and this was about information theory and gambling, and in the meantime, people adapted the Kelly criterion to the world of investing, and I've been pioneering also in the application of the Kelly criterion. So I just wanted to give you these backgrounds. And Kelly criterion is very useful for you to know what kind of leverage you can use when it comes to investing, because beyond a certain point, leverage is very destructive, especially if you are investing in a volatile stocks like AI stocks. Finally, reason number 3 why his fund went belly up was lack of hedging. You know, hedge funds, they go long and also go short or have some kind of delta neutral strategies. Basically, they always buy insurance in case there is a downside, right? To have downside protection. And basically there was no downside protection here. There was extreme leverage without downside protection. It seems that he was also shorting some stocks, but the stocks that he was shorting went against him. So basically all his positions were against him. The ones that he was buying for X leverage were coming down. The ones that he was shorting, he was betting on a decline, they were going up. So everything went against him at the same time, meaning that there was no hedging strategy in this fund. So this was pretty much lack of risk management, too much leverage, very concentrated portfolio, and also no hedging. And this is basically how big investors can go belly up. Being liquidated and losing everything, it's something that investors keep doing again and again and again. Jesse Livermore over 100 years ago went bankrupt 3 or 4 times because he was using excessive leverage. More recently, you have funds like Archegos, Bill Huang, who was also a very smart guy, but he was using like 10 to 20x leverage, also went belly up, imploded a multi-billion-dollar fund. LTCM was so large and so leveraged that even the Federal Reserve had to intervene to avoid an economic collapse in the United States. And now Leopold Aschenbrenner situational awareness, same situation, and basically very smart people can go belly up if you don't have the proper risk management and if you are not using the proper levels of leverage. So what I teach in my Henrique Wealth Academy is how to use leverage properly. I have sometimes people joining the academy and asking, okay, can I use these 2 or 3x leverage ETF on individual stocks? It's like, no, please don't do that. But you can probably use some level of leverage to invest in broad markets, in S&P 500, NASDAQ, and so on. I want you to do well as an investor. I want to maximize your returns, but I want you to have a good risk control. All right, guys, if you enjoyed this video, give it a like and subscribe, and I'll see you very soon. Bye-bye.